It is my pleasure to welcome you all in today's panel discussions on the topic contemporary issues in the monetary policy. Monetary policy is considered as the most powerful economic instrument used by the central banks in maintaining the macroeconomic stability, including GDP of the country, employment, and other things. But in today's digital modern economy, what's going on is the central banks are facing more challenges in terms of digital transformations, inflationary pressures, and other things. So, to provide deeper insight into these issues, we are joined by 5 different panelists, each specializing in the key areas of the monetary policy. Today's discussions will mainly focus on the unconventional monetary policy, financial crisis management, monetary policy transmission mechanisms, challenges and constraints faced by policymakers, and lastly, the fintech innovation and the future of the monetary policy. So, to begin with, let us hear from the panelist one regarding the unconventional monetary policy.
Thank you, moderator. My name is Tandil Azir, and I will take you through the unconventional monetary policy. First of all, the unconventional monetary policy became highly important after 2008 global crisis, when the traditional tools such as lowering the interest rate become inefficiency or ineffective. And then after, the central bank has introduced some measures such as quantitative easing, negative interest rate, and forward guidance and liquidity facility. For example, the U.S. Federal Reserve purchased government bond to inject liquidity into economic and encourage lending. Similarly, the European Central Bank and the Bank of Japan adopted a negative interest rate to stimulate spending and investment. And this policy helped to stabilize the financial market and avoid economic collapse. However, there are some criticism, like quantitative easing increases asset price and wealth inequality, and long-term lowering the interest rate may create financial bubbles, and lastly, excessive liquidity may increase the inflation risks. Therefore, the conventional policy are effective during the crisis, but may create a future economic challenges. Thank you.
Thank you to our expertise on the unconventional monetary policy tool. So the discussion was insightful, and if I draw the conclusions, the policy tools ultimately these tools can be some challenges in the economy later days. Now, to go on with the financial crisis management on panelist 2, so let's hear how central banks manage crisis in the economy.
Thank you, moderator. My name is Tempo Gelson. To go on with financial crisis management, financial crises are major tests of the effectiveness of monetary policy and the stability of the banking system. During the 2008 period of economic instability, banks often face liquidity shortages, declining asset values, and a loss of public confidence, which can threaten the entire financial system. In such situations, central banks play a critical role in maintaining stability and preventing economic collapses. One of the most important functions of central bank during a crisis is acting as the lender of last resort, where it provides emergency funds to financial institutions that are temporarily unable to meet their short-term obligations. This support helps restore confidence in the banking sectors, prevents panic among depositors and investors, and reduce the risk of widespread bank failures. During the 2008 global financial crisis, many major financial institutions faced severe liquidity problems due to collapse of housing markets and the growing number of loan defaults. Banks become reluctant to lend to one another because of uncertainty and fear of insolvency, causing credit markets to freeze. In response, central banks such as the Federal Reserve and the European Central Bank introduced emergency monetary policies, including lowering interest rates, purchasing financial assets, and providing large-scale liquidity support to banks. Government also introduced rescue packages and guarantees to stabilize the financial system. These measures help prevent a complete collapse of global financial markets and support the gradual recovery of the global economy. Similarly, during COVID-19 pandemic, economics around the world experienced severe disruptions caused by lockdowns, reduced consumer spending, and business closure. To reduce the economic impact, central banks quickly lowered the interest rates and introduced expansionary monetary policies to increase liquidity in the economy. Massive financial support programs were introduced to assist business, households, and financial institutions. Many central banks also used quantitative easing, where they purchased government bonds and other financial assets to stabilize markets and encourage lending. These actions help maintain financial stability, support employment, and reduce the severity of the global recession caused by the pandemic. However, financial crisis interventions also create important challenges. One major concern is moral hazard, which occurs when banks and financial institutions take excessive risks because they expect central banks or governments to rescue them during crisis. If financial institutions believe they will always receive support, they may engage in risky lending and investment activities without fully considering the consequences. This can increase the likelihood of future financial instability and create long-term weakness in the banking system. Another significant challenge for policymakers is balancing financial stability with inflation control. During crisis, central banks often inject large amount of money into the economy and maintain very low interest rates to stimulate growth. While these policies are effective in supporting markets and preventing economic collapses in the short term, excessive monetary stimulate over a long period can contribute to rising inflation, asset bubbles, and market distortion. Policymakers must therefore carefully manage the timing and scale of their interventions to ensure the economic recovery. Therefore, financial crises demonstrate the crucial role of central banks and monetary policy in maintaining economic stability. Emergency interventions can successfully restore confidence, support financial institutions, and protect economics from severe downturns. However, policymakers must also consider the long-term consequences of these actions, including moral hazard, inflation risks, and financial market distortion. Effective crisis management requires a balance between providing immediate economic support and maintaining sustainable financial stability in the future. Thank you.
Thank you. Second panelist, expertise on the financial crisis management, for highlighting the important role that central banks faced during financial crisis and the challenges associated with it while maintaining the economy. However, the monetary policy is only effective when it influences the broader economy. Now, to understand more about this, I would like to invite our third panelist to talk about the monetary transmission mechanism.
Morning, fellow panelists and everyone present out here today. My name is Nongtobdin Gelson and I am honored to serve as panelist 3 for today's discussion. My area of focus will be on monetary transmission mechanism, specifically how monetary policy decisions are transmitted through various channels such as interest rate, credit, exchange rate, asset price, and expectation to influence the economic activity, inflation, and financial stability. Through this discussion, I hope to provide a clear understanding of importance of these transmission channels in achieving effective monetary policy implementation. So, as a third panelist, I would like to explain the monetary transmission mechanism, which is the process through which monetary policy decisions affect the overall economy. When the central bank changes interest rate or the money supply, the impact does not occur instantly. Instead, the effect passes through different channels that influence spending, investment, inflation, employment, and economic growth. Understanding these channels is very important because they show how monetary policy moves from the financial system into the real economy. The first and most common channel in the interest rates. When the central bank increases the interest rates, borrowing becomes more expensive for household and the business. People may reduce spending on the houses, cars, or consumer goods because the loan and mortgages cost more. Business may also delay the expansion of project or the investment plans due to higher borrowing costs. Demand in the economy slows down, which helps to reduce the inflationary pressure. On the other hand, when the interest rate is lowered, borrowing becomes cheaper, encouraging the consumption and investment, which supports the economic growth. The second channel is the credit channel. Monetary policy also affects the availability of the loans in the banking system. When the central banks tighten the monetary policy, commercial banks may reduce the lending because reserve becomes limited and the financial conditions become stricter. Small business and households that depend heavily on the bank credit may struggle to assist the financing. This reduction in lending slows the economic activity. In contrast, the expansionary monetary policy increases the liquidity in the banking sector, making banks more willing to provide loans, which stimulates spending and production. Other important channel in the exchange rate channel. Changes in interest rate can influence the value of country's currency. For example, if the interest rate rises, foreign investors may invest more in the country to earn the higher returns. Increasing demand for the currency and causing to appreciate, a stronger currency makes imports cheaper, but exports more expensive international market. Exports decline, aggregate demand may fall, helping reduce inflation. Conversely, lowering the interest rate may weaken the currency, making the exports more competitive and supporting the economic growth. The asset price channel also plays the vital role. Monetary policy influences the price of the financial assets such as stocks, bonds, and real estate. Lower interest rates often increase the stock market prices because investors seek higher returns in the financial market. Raising the asset price increases the household wealth and business confidence, encouraging more spending and investment. However, interest rate may reduce the asset price, lowering the wealth, slowing the economic activity. Finally, there is the expectation channel, which is extremely important in the modern economics. Monetary policy works not only through the actual policy changes but also through the public expectation about the future economic conditions. If the business and the consumer believe that the central bank is committed to controlling the inflation, they may adjust their spending, pricing, and wage decision accordingly. Positive expectation can strengthen the effectiveness of monetary policy, while uncertainty or lack of confidence can weaken it. However, these transmission mechanisms do not always work perfectly. During the periods of economic uncertainty or financial crisis, people and business may hesitate to borrow or invest when the interest rates are very low. This situation is often referred to as liquidity trap. In such case, traditional monetary policy becomes less effective because confidence in the economy is weak. This is clearly observed during the global financial crisis, while the central bank had to introduce the unconventional monetary policies such as quantitative easing to support the economic recovery. In conclusion, the monetary transmission mechanism is essential because it explains how the central bank policy influences the economic activity, exchange rate, asset price, and expectation. The effectiveness of these channels determine whether the monetary policy can successfully achieve the goals and the price stability, economic growth, and the employment. Thank you.
Thank you, our panelists, for clearly explaining how monetary policy decisions affect our savings, investments, and overall economy. Despite these transmission channels, I believe the policymakers still face some numerous practical challenges and constraints. Now, to discuss about this in more greater detail, let us hear from the fourth panelist, expertise on challenges and constraints faced by the policymakers.
Thank you, moderator, for this insightful opportunity for today's panel discussion. My name is Sanjit Roy, and today I will talk about some challenges and the constraints faced by the central banks while making the policies. As we all know that central banks are responsible for implementing the policies, and central banks faces the several major constraints while implementing the monetary policies, especially in the high interconnected and the uncertain global economy. Although the central banks are responsible for the maintaining price stability, supporting economic growth, and ensuring financial stability, achieving all these objectives simultaneously is often difficult. Monetary policy discourses can have wide-range effects on inflation, employment, investments, and exchange rates. As a result, the policymaker must carefully balance competing economic growth while responding to both domestic and international challenges. One of the biggest challenges faced by the central bank is the trade-off between controlling inflation and the supporting economic growth.
Thank you, fourth panelist, for meaningfully sharing the trade-off and the global challenges faced by the central banks and the policymakers. So, as a key takeaway, so achieving the macroeconomic goals like price stability, economic growth, and employment, and other things, these things cannot be achieved simultaneously. So, as financial systems continues to evolve, so technology is becoming increasingly important in shaping the futures of the central bank or the monetary policy. So, with this in mind, I would like to invite our final panelists to discuss on fintech technology and the future of monetary policy.
Thank you for the question, and good morning everyone. I am Sing Bin So, and today I would like to talk about how technological innovation is changing the future of monetary policy. The rise of digital payment, cryptocurrency, fintech companies, and central bank digital currency, in short, CBDC, is transforming the way financial systems operate. Digital payment systems have made transaction faster, easier, and more efficient. They also improve financial inclusion by giving more people access to financial service through mobile phones and online banking. At the same time, fintech companies are introducing new innovative financial services that make banking more convenient for users. However, the growth of cryptocurrencies such as Bitcoin has created challenges for governments and central banks. Since cryptocurrency operates independently from central bank, they are harder to regulate and monitor. Their prices also are highly unstable, which can create financial risks. Because of these changes, many countries are now exploring CBDCs or central bank digital currency, which are digital versions of national currencies issued by central banks. One example is China's digital yuan, showing how governments are adapting to the digital economics. CBDCs could improve payment systems and help central banks maintain control over monetary policies. Despite the benefit, there are still important challenges, including cybersecurity threats, privacy concerns, and possibility of disturbing commercial banks. And in conclusion, technological innovation is reshaping the financial world. To remain effective, central banks must modernize their monetary policy tools and adapt to the growing digital financial environment. Thank you.
Thank you, final panelist, for sharing a realistic information about the technology and the monetary policy. So once again, thank you, experts, for sharing a realistic and the thoughtful information. So now we will move into an interactive discussion sessions where we explore some broader perspectives and engage in the short debate of the future directions of the monetary policy. So the question to our first panelist is, was quantitative easing more beneficial or harmful in the long term?
Thank you for the question. The quantitative easing was highly beneficial during the economic crisis because it helps to stabilize financial market and support economic recovery. During the periods such as the 2008 global financial crisis and COVID-19 pandemic, a central bank purchases government bonds and other financial assets to inject the liquidity into the economy. This increases the money supply and lower the interest rate and encourage banks to lend more to the business and household. As a result, the quantitative easing helps to restore the confidence in the financial market and prevent major financial institutions from collapsing and support economic activity when the traditional monetary policy tools becomes less effective. Lowering borrowing costs also allows business to continue operate and government to financially engage or spending programs. However, while the quantitative easing was effective in short run, the problem was that how the quantitative easing can create several negative consequences. And the one major consequences is the increase in economic inequality. Quantitative easing often raises the price of financial assets such as stocks, bonds, and real estate. Since the wealthier individuals are more likely to own their asset, they will benefit more from the increase in the asset value, while the lower income group may limit the direct gain. This can widen the gap between the rich and poor over the time. However, another issue is the financial market distortion. Because quantitative easing keeps interest rate very low from the extended period, investors may take excessive risks in searching of higher return. This can lead to asset bubbles in the stock market or housing market, where the price is rise beyond their true own economic value. Prolonging the quantitative easing may also reduce market inefficiency because the financial market becomes heavier dependent upon the central bank to support rather than making normal market forces. If the central bank suddenly reduce quantitative easing or increase the interest rate, the market may experience instability. Therefore, although quantitative easing was important tool for stabilizing the economy during the crisis, its long-term use must be carefully managed to avoid the creating inequality and distortion in the financial market. Thank you.
Thank you for your meaningful response. So my So my next question to the expertise on financial crisis management is, how can central banks avoid moral hazard during financial crisis?
Thank you for the question. It can be avoided by strengthening financial regulations and ensuring the rescue measures are temporary and conditional. Thank you.
Thank you. So my next question to our expert on the monetary transmission is, in modern economics, are interest rate channel alone still enough to influence economic behavior effectively or not?
Thank you. The most effective transmission channel often depends on the condition of the economy and the structure and the financial systems. However, in the most economics, the interest rate channel is generally considered the most vital or the important and widely used channel, because changes in policy rates directly influence the borrowing cost, consumer spending, and the business investment. When the interest rate rises, the people borrow less and spend less, which helps to reduce the inflation. When the rate falls, the borrowing and investment increase, stimulating the economic growth. At the same time, the expectation channel has become increasingly important in the modern economic policy. If the people trust the central bank and believe the inflation will remain stable, their economic decisions will align with the policy goals, making the monetary policy more effective even before actual changes fully occurs. During the financial crisis, however, the credit channel may become more significant because the availability of the loans and the liquidity in the bank directly affects the economic recovery. Therefore, no single channel is always the best. The effectiveness depends on the economic conditions, public confidence, and the stability of financial system.
Thank you for your answer. So my question to next panelist is, should central bank prioritize inflation or economic control?
Thank you for the question, moderator. The question was, should central bank prioritize inflation or economic growth? To answer this question, the central bank should maintain a balance between controlling inflation and promoting economic growth, because both objectives are closely connected to the overall stability of the economy. If a central bank focuses only on controlling inflation, it may increase its interest rate too much. Higher the interest rate can reduce the borrowing investments and the consumer spending, which may slow down economic activities. And for the example, firms may avoid expanding their operations due to the expensive loans, and the consumers may spend less on the goods and services. So therefore, the central banks need to carefully balance between both the objectives. Moderate inflation with stable economic growth is considered ideal because it creates confidence among the business investors and the consumers. Policies such as the adjusting interest rate, controlling money supply, and the monitoring unemployment levels help central banks maintain this balance, ensuring long-term economic sustainability. Thank you.
Thank you. So my final question to our final panelist is, in your opinion, will CBDCs replace physical cash completely or not?
To answer your question, CBDCs are unlikely to replace physical cash completely in the immediate future, but they are expected to become a very important part of financial system in the coming years. Even though digital technology is advancing rapidly, physical cash still plays a major role in many economies around the world. First, many people still rely on cash for their daily transactions. In rural areas and developing countries, not everyone has access to smartphones, internet services, or digital banking systems. For these people, cash remains the easiest and most reliable method of payment. Elderly population may also prefer physical money because they are more familiar and comfortable using it. Because of this reason, it would be very difficult for governments to completely eliminate cash in the near future. Another reason cash is still important because it provides a sense of privacy and independence. Physical cash transactions are direct and do not require digital system or internet access. During emergencies such as power failures, technical problems, or crypto attack, cash can still function normally. This is why central bank believes physical currency should continue to exist even as digital system expanded. However, the use of digital payment has increased significantly in recent years. More people now use mobile banking apps, online transfers, and QR code payment systems because they are faster and more convenient. Business also prefer digital transactions because they reduce costs and improve efficiencies. As society becomes more digital, central banks are exploring new ways to modernize their financial system, and this is where CBDCs becomes important. A central bank digital currency, or CBDC, is a digital version of country's official currency issued and controlled by central bank. And unlike cryptocurrencies such as Bitcoin, CBDCs are regulated by governments and designed to maintain financial stabilities.
Thank you for your information. So as we conclude today's discussion, so it's clear that the monetary policy remains the most important tools supporting economic growth and achieving other macroeconomic goals. On the other hand, the technological innovation, digital finance, cryptocurrencies, CBDCs are transforming the futures of the central banks, and the banks and the policymakers must remain flexible, innovative, and able to balance these things for economic stability and sustainable growth. With this, thank you all for your realistic and meaningful information. Thank you.